I'm going to share with you 6 simple day trading strategies that I've collected over the past 4 years of trading full time. These range from futures markets to equities to ones that can be applied to all markets. I'm unbiased trading, and let's dive straight into this. The first one is the 25 SMA Deviation Strategy. This strategy is inspired by a $12 million Japanese day trading legend, BNF. The basic idea is to look for a stock that has deviated more than 2.5 times from its 10-day moving average. If the stock is above the 10-day moving average, then you would sell it. If it is below it, you would buy it. And you could really mess around with the time frame, the amount of deviation needed from the 10-day moving average, the moving average period length. You could really experiment with all these. And the main idea of this video is to give you ideas for different strategies you can even implement or change or even take parts of, as you like the idea of how it's creating a mean reversion or trend kind of filtering. Next is shorting intraday overextensions. This strategy is based on the idea that stocks sometimes move too fast and too far, and they will most likely mean revert back to the mean or have some kind of extension downwards based on that extension upwards. To use this strategy, you would look for a stock that has moved X percentage in X amount of time. So this could be 30% in 10 minutes, for example. Once you find a stock like this, you would then begin to short it if it is an extension upwards. And mainly that's what we're focusing on here, and like focusing on the small cap kind of market with an extension upwards intraday. Your stop loss could be a percentage of your entry price, or it could be more complex. You could even use like a moving average, for example. Your profit target could be the end of day, or it could be a moving average, or a certain amount of time after the extension, things like that. Feel free to play around with different variables and see how the kind of results change. Next is Bollinger Bands. Now, Bollinger Bands are a technical indicator that measure volatility. They consist of 2 bands, an upper band and a lower band. The bands are calculated using the moving average and the standard deviation from the stock's price. To use this strategy, you would look for stocks that have pushed outside of the Bollinger Bands. If a stock pushes above the upper band, you would short it. If a stock pushes below the lower band, you would buy it. You take profit would be at the mean line, which is the middle line of the Bollinger Band. Your stop loss could also be a percentage of your entry price, or it could be more complex. You could have a certain percentage away from the lower band, for example. You could have, the ATR. You could really do any kind of different ways. And these have worked kind of throughout time. Now, I will say the key here is the strategy is super simple, but the filtering is what's going to be crucial. You will get a ton of signals if you don't apply any kind of other filters on this, whether that's volatility filters, some kind of confirmation check, whether that be like, if it's going below the Bollinger Bands, then you're waiting for a green candle of a certain size, stuff like that. You can really play around with different ideas. Next is shorting pre-market gappers. This strategy is based on the idea that stocks that gap up significantly in the pre-market often fade, and this has just historically been tested for my own strategies, and you can even pull the data yourself and see that in the small cap realm, things that significantly gap up, so we're looking for 50% plus, 100% plus in the pre-market, historically have closed red more often than they have closed green. To use this strategy, you would look for stocks that have gapped up more than 50% in the pre-market, for example. Once you find a stock like this, you would short it at the open. Your stop loss could be a percentage of your entry price, or it could be something more complex where you're using pre-market high. And your profit target could be end of day or touching a certain EMA, things like that. Now, be aware, sort of with the Bollinger Band strategy as well, a lot of this is filtering. You're going to get a lot of these moves where there can be a lot of danger, like halts, really high volatility moves, and having a wide stop doesn't always give the best benefits depending on what you're kind of optimizing for. Personally, for me, I optimize for kind of low drawdowns, and I don't mind sacrificing some profits for lower drawdowns. So I still use semi-wide stops where it's about 15%, but it does kind of have its downsides if you're using 30%, because a lot of the time you're going to be, if you get one big outlier loser, that 30% is going to hurt you quite a lot, especially based on sizing and liquidity issues. So there's just more things to think about when you are using a really wide stop like that. But for an initial beginning strategy, it can be a really good way to go down, and then you can start adding and refining to it and iterating on it. Next is spread trading. So this strategy involves profiting off the difference between the spread of 2 symbols. For example, you could go long the Nasdaq 100 and short the S&P 500, or NQ and ES. When the spread between the 2 symbols is extended, you would exit your trade when the spread narrows pretty much. To learn more about this, I'd really recommend checking out Trade Like a Hedge Fund book that goes over unilateral pairs trading and other kind of strategies along the pairs trading realm and gives you some really other good ones. I've recommended it before. I think I even have a video on it if you want to check it out. But for a general example in his book of how he calculates the spread for correlated instruments, you would normally first look at something like NQ and ES, for example, where you could do NASDAQ and S&P if you want to do equities. You would then take their current price or closed price. So for example, if we did 50.34 and 27.40, we would then divide these two and you'd get 0.544. And then this, you would be calculating the 20-day moving average on that ratio and then calculate how much the current ratio differs from the moving average. This gives you the delta for the ratio difference. And then there are a couple more steps from there where you'll really end up with a normalized delta difference. And that's how you calculate the spread between those. But it's a really cool method and it's really interesting to read about how you can calculate that kind of spread, delta and difference between these two correlated instruments. So if you do want to go down that route, be sure to check out that book. He does a way better explanation of it than just this kind of quick video of me talking about it. Next is the dip buying strategy. This strategy involves buying an instrument as it dips into an SMA or EMA along a trend. To use this strategy, you would first need to identify a trend. You could do this by using a trend strength index or another method of your choice. Once you have identified a trend, you would look for stocks that are dipping into their SMAs or EMAs, and when you find a stock like this, you would simply be buying it at those dips. Your profit target could be fixed or trailed. Your stop loss could be static or percentage away from the SMA or EMA or your entry price. Really, all those kind of things are up to you and to experiment with different methods. As a lot of strategies that at least I've encountered too, the benefit has been someone showing me the idea and then I kind of go away and play with different variables and different ideas I like that could combine well with that. And that can be based off experience, knowledge of reading different books or from working with different traders. All those kind of things come into it. Now, these are just 6 simple day trading strategies that you can use. There are many other strategies out there, and the best strategy for you will really depend on your individual trading style and risk tolerance. But before you start using any new strategy, it's important to backtest it thoroughly. This means using the strategy on historical data to see how it would have performed. Once you're satisfied with the backtest results, you can start using that strategy live. Now, if you're new to backtesting or you're looking to turn your intuition to black and white stats, I actually run a How to Backtest Bootcamp, which is reopening for November. We've just passed over 60 members total, and if you're wondering what it is a pre-recorded online bootcamp with one-on-one guidance calls to help you understand and apply backtesting and data into your trading using code, but with no coding experience needed. So you're no longer wasting money on bad strategies or doubting your edge when executing because you value growth in your trading and understand really to build conviction and optimize, you need to backtest your strategies. If you enjoy my YouTube content, then you'll be sure to find tons of value in the bootcamp as my YouTube really goes over about 20 to maybe 10% of all the information I provide about backtesting and applying data. If that sounds good to you, there's a link in the description below that you can click. It'll take you to the Backtest Bootcamp website where you'll be able to input your email and sign up to get an unreleased video that I've never published on my YouTube, and that holds a lot of value by going over the top 5 mistakes I made that cost me 15 grand. I hope you enjoy it and find value in it, and if you don't, no worries, I'll see you on Twitter, and I really hope you enjoyed this video. Thank you for watching, and if you enjoyed it, please like and share it with anyone else who might be interested.